Investing is often sold as a numbers game. We think it's about spreadsheets, formulas. We believe that the smartest people, the most advanced degrees, must be the best at it. But that's rarely the whole story. If it were, every mathematician and economist would be fabulously wealthy. The truth is much simpler and far more human. How you behave is more important than what you know. Your relationship with fear, greed, will determine your long-term success. More than your ability to read a balance sheet, it's a psychological game, not just an intellectual one. The real battlefield is not the stock market, your own mind. You don't need to be a rocket scientist to understand the basics of good investing. Buy good companies, hold them for a long time, diversify. The concepts are not complicated. The hard part is sticking with the plan when things get scary, or when it feels like everyone else is getting rich faster than you are. All market behavior, when you boil it down, comes from two powerful emotions: fear, greed. They are opposite sides of the same coin, and they have been driving financial markets since the very beginning. Greed is the engine of bull markets. It's the whisper that tells you this time is different. It's the feeling of wanting more. Seeing your neighbor get rich off a hot stock, thinking you need to get in on the action. Greed is the desire for easy money. It makes us believe prices can only go up. It pushes asset prices to unsustainable heights. Then comes fear. It's the cold, sickening feeling in your stomach when you see your portfolio value plummet. While greed builds slowly, fear can arrive in an instant. It's a much more powerful, more primal emotion. Fear is what makes a 20% market drop feel like the end of the world. It screams at you to sell everything, to get out now before you lose it all. Fear doesn't care about your long-term plan. It cares about survival, right here, right now. It is the driving force behind market crashes and panics, turning orderly selling into a stampede for the exits. This is where the biggest mistakes are made. Selling in a panic locks in your losses. Fear makes people sell low, just as greed made them buy high. It's the perfect recipe for destroying wealth. The assets you sell in a panic are bought by someone else, someone who is controlling their fear. The market is a device for transferring money from the impatient to the patient. And patience is nothing more than the ability to master your fear when everyone else is losing their minds. Our brains are wired with mental shortcuts known as cognitive biases, but in investing, these shortcuts often lead us down the wrong path. One of the most common is overconfidence. We all like to think we are above average. This bias leads us to believe we can pick winning stocks and time the market, even though mountains of evidence show that most people can't. Overconfidence makes us trade too often, which racks up fees and taxes, and it causes us to concentrate our money in a few sure things instead of diversifying. Another dangerous trap is confirmation bias. This is our tendency to seek out and believe information that confirms what we already think. If you are excited about a particular stock, you will naturally look for news articles and analyst reports that say it's a great buy. You will subconsciously ignore or dismiss any information that suggests it might be a bad investment. This creates an echo chamber where your own beliefs are reinforced, making you more and more certain you are right. Herd mentality is perhaps the most powerful bias in finance. We are social creatures, and we find safety in numbers. Following the herd feels safe and rational at the moment, but it's a strategy that almost guarantees you will buy high and sell low. Finally, there's anchoring bias. The market has no memory of what you paid. The current price is all that matters. Letting go of these anchors and evaluating an investment based on its current merits is a skill that separates successful investors from the rest. Markets move in cycles. They always have, and they always will. These cycles aren't driven by calendars or formulas. They are driven by human emotion, swinging back and forth between optimism and pessimism like a giant pendulum. When times are good, people's collective greed starts to build. A little bit of good news leads to higher stock prices, which creates more optimism, which leads to more buying, and even higher prices. This feedback loop can go on for a long time. People start to believe the good times will last forever. This is the phase of euphoria, the peak of the cycle. Eventually, something happens to break the spell. Maybe it's a bit of bad economic news or an unexpected event. The market stumbles. The people who bought at the very top start to get nervous. A small decline can trigger anxiety, which leads to some selling. As prices fall, that anxiety turns into denial and then into fear. The feedback loop that pushed prices up now works in reverse. Falling prices create more fear, which leads to more selling, which causes prices to fall even further and faster. The herd that was so happy to buy on the way up is now stampeding to sell on the way down. This downward spiral culminates in a phase called capitulation. This is the point of maximum pessimism. It's when investors who held on through the decline finally give up. They can't take the pain anymore and sell everything just to make it stop. From the ashes of capitulation, the cycle begins anew. With all the sellers exhausted, the market finds a floor. The financial media is not there to help you make good long-term decisions. It's a business, and its business model is to get your attention. It does this by focusing on what is new, what is exciting, and what is scary. Calm, patient, long-term investing is boring. It doesn't generate clicks or TV ratings. Market crashes, sensational predictions, stories of overnight crypto millionaires do. The media, therefore, acts as an amplifier for our emotions. It pours gasoline on the fires of fear and greed. That makes it much harder to stay rational and disciplined with investments. During bull markets, the media is filled with stories of success. You'll see headlines about the new paradigm and interviews with market gurus who have cracked the code. Financial news channels will parade newly minted millionaires across the screen. This constant stream of positive reinforcement fuels our FOMO. It makes us feel like we are missing out if we aren't taking big risks. When the market turns, the media's tone shifts instantly. The headlines become dark and ominous. Market in turmoil, billions wiped out. Is this the next Great Depression? The key to survival is to learn to filter out the noise. Turning it off, or at least learning to ignore it, is one of the most powerful moves you can make. History is filled with stories of brilliant people losing their fortunes because they couldn't control their emotions. Perhaps the most famous example is Sir Isaac Newton. Newton was one of the greatest scientific minds. He formulated the laws of motion and universal gravitation, but he was no match for the emotional pull of a market bubble. In the early 1700s, he invested in the South Sea Company. He made a handsome profit early on and wisely sold his shares, doubling his money. He watched the stock continue to soar. His friends who stayed in were getting fabulously rich. The pull of the herd and the fear of missing out became too much for him. Newton jumped back in, buying South Sea shares near the very peak of the bubble. Shortly after, the bubble burst spectacularly. The stock collapsed, and Newton lost a fortune, far more than his initial gains. He said, "I can calculate the motion of heavenly bodies, but not the madness of people." His story proves intelligence isn't a defense against emotional investing. We don't have to look back 300 years to see the same story. The dot-com bubble of the late 1990s is a more recent example. People were quitting their jobs to become day traders. The story is always the same, only the names change. So, how do you avoid these emotional traps and become a more successful investor? The solution isn't to find a better stock-picking system, it's to build a better behavioral framework. The first and most important step is to have a plan. Before you invest a single dollar, write down goals, time horizon, strategy. Decide in advance how you will react to a market decline. For example, you might decide, if the market falls 20%, I will not sell anything. I will consider rebalancing, adding to my positions. Making these decisions when you are calm and rational prevents you from making emotional mistakes in the heat of the moment. Second, automate your decisions as much as possible. Set up automatic contributions to your investment accounts every month. This strategy, known as dollar-cost averaging, forces you to invest consistently, regardless of what the market is doing. It removes emotion from the equation. When prices are high, your fixed dollar amount buys fewer shares. When prices are low and fear is high, that same dollar amount buys more shares. Third, understand that volatility is normal. It is the price you pay for the higher long-term returns that stocks offer. Market declines are not a sign that something is wrong. They are a regular feature of investing. Instead of viewing a bear market as a disaster, you can learn to see it as an opportunity, a sale on great companies. Finally, focus on what you can control. You can't control the economy, interest rates, market returns. What you can control is your savings rate, your asset allocation, your fees, and most importantly, your own behavior. Success in investing comes down to a few simple things done consistently over a very long period.